Ben was sitting there thinking about the investment world. There was a seductive fantasy floating around him, a dream that seemed so reliable, logical, and tangible that it dragged millions of people into an endless cycle of self-deception. This dream was called passive income. Ben saw these videos on YouTube. I read the posts on the forums. The idea was simple. You buy stocks, hold them forever, and every quarter a check magically appears on the brokerage account. Ben imagined himself on a beach in Thailand, sipping a cocktail, paying bills with these checks, while his initial investments remained untouched, or even growing. It seemed like it was free money. Ben thought, as long as I don't sell the shares, I'm not violating the principles, and the dividends are just the icing on the cake, the reward for my loyalty. This idea became the basis of the community of dividend investors, a cult where selling shares was considered a sin, and profitability was considered salvation. But I'm here to tell you that this is probably the most costly psychological mistake in modern finance. The unpleasant truth that dividend investors will shout at Ben for is that dividends don't matter. This is not free money. This is the forced liquidation of your own asset. When the company pays Ben dividends, it simply takes the money out of his left pocket and puts it in his right, and the tax service stands in the middle and takes its share of the transfer. My name is Ben, and I spend too much time exposing the lies we tell ourselves in order to feel safe with money. We will study the theory of the irrelevance of dividends, a Nobel Prize-winning economic concept that proves that paying dividends does not increase your wealth by a single cent. We'll look at the simple math behind the stock's price decline on the cutoff day. Let's reveal the brutal tax inefficiency of forced payments, and let's explain why selling shares of a growing company is mathematically identical to receiving dividends and often brings more benefits. To understand why dividend fantasies are a trap, Ben had to put aside emotions and look at the simple mechanics of what happens on dividend day. Most people treat stocks like magic bonds that pay interest, but shares are partial ownership of a business. Ben has a small business empire of lemonade stands. There is exactly $1 million in cash in the corporate bank account. Ben owns 100% of the shares. The value of his share is inextricably linked to this money. The business is worth $1 million, and then Ben decides to pay himself a dividend of $100,000. He transfers this money from his business account to his personal account. Does he have more money? No. He has $100,000 on his hands, but his business is now worth only $900,000. Ben's total net worth has not changed. He simply transferred the money from a pocket labeled business to a pocket labeled personal. Ben didn't get richer. The company simply liquidated part of its value and transferred it to him. It's like withdrawing cash from an ATM. You have cash on hand, but you have less in your account. Ben wouldn't jump for joy while withdrawing money from an ATM. So why should he be happy about the dividends? The problem is that Ben's brain is programmed to separate capital from income. This is a distortion from an era when transactions were complex and expensive. Ben sees the stock price as a golden goose and the dividends as a golden egg. He's afraid to sell part of the goose because it feels like murder. But in the modern era of trading with zero commission and fractional shares, the difference between receiving 4% of the dividend yield and selling 4% of the shares in a company that does not pay dividends is zero. In both cases, Ben generates 4% of the cash flow. In both cases, the remaining value of his investment is reduced by 4%. The difference is only psychological. The dividend investor feels safe because the number of shares has remained the same, even though their value has fallen. A growth-oriented investor is nervous about having fewer shares, even though the value of the remaining ones is higher, because the company reinvested the money in growth rather than giving it away. This is called a self-made dividend. Ben can get any return from any company by simply selling part of the portfolio. He doesn't need the CEO to do it for him. He doesn't have to limit himself to slow-growing companies just to pay the bills. In fact, if Ben lets the CEO do it for him, it will be a tax disaster. When a company pays dividends, Ben is not in control of the situation. He gets the money, whether he needs it or not, and on a regular brokerage account, he he immediately has to pay taxes. Even if he reinvests the dividends, the tax will still have to be paid. When Ben sells shares, he is in full control of the process. He decides when to sell. He can choose stocks with the highest cost to minimize income taxes. He can wait a year when his income is lower and sell. He may not sell at all if the money is not needed, allowing the capital to grow with deferred tax. This flexibility is a huge mathematical advantage that dividend investors give up voluntarily. Chasing profitability, they create a tax burden that drags the portfolio down for decades and reduces overall profitability compared to a strategy focused on growth and effective sales. Moreover, a company's decision to pay dividends is often an admission of defeat. Ben likes to think of dividends as a sign of a strong, healthy company. Sometimes it's true, but it's often a signal that the company has run out of ideas. When companies like Apple or Microsoft were in the hypergrowth phase, they didn't pay dividends. Why? Because the management believed that they could make high profits by reinvesting money in new products, research, and expansion. They believed that the dollar left inside the company would turn into $5 in the future. When a company starts paying large dividends, especially with high returns, management essentially says, "We don't have a better use for this money. We don't see any new factories, competitors to buy, or technologies to develop that would make a profit, so we'll just give you a refund." The pursuit of high returns often leads Ben into a value trap. Dying companies in declining industries pay out cash because they are gradually liquidating themselves. Ben buys a melting ice cube because he likes the puddles it leaves. He puts payments above the sustainability of the business. Whatever Ben does, he must not confuse the dividend yield with the total return. Total return is the only indicator that matters. This is a combination of price growth and reinvested dividends. If stock A pays 10% of the dividend, but its price drops by 5% each year due to the decline of the business, Ben's total return will be only 5%. If B's stock does not pay dividends, but its price increases by 10% every year because the company reinvests profits in a fast-growing sector, Ben's total return will be 10%. Action B wins. Ben can't pay bills with profitability. He pays for them with capital. If he has $1 million worth of B shares, he can sell 4% of them to pay the bills, and his portfolio will still grow. If he owns a million shares of A, his capital will decrease. Being fixated on dividends prevents Ben from seeing that he often underestimates the market as a whole. Just to get this psychological hit from the cash flow, he swaps long-term wealth for short-term comfort. Warren Buffett is the most convincing proof of the dividend trap. The Oracle of Omaha likes to receive dividends from the companies he buys because his company pays a lower tax on dividends than Ben. But look at his own company, Berkshire Hathaway. It is one of the most successful financial companies in history. She has a lot of cash, but she has never paid a dividend. Why? Because Buffett is good at math. He knows that if he pays dividends, his shareholders will pay taxes, and the capital will leave the company. He believes that he can distribute this capital better than they can. He believes that maintaining profits creates more value for the shareholder in the form of an increase in the share price than its distribution. If Ben trusts Buffett's genius enough to quote him, why doesn't he trust his actions enough to emulate them? How does Ben get out of the dividend trap? He needs to stop treating dividends as a salary and start seeing them as a forced partial sale that he didn't ask for. He needs to completely switch his attention to total profitability. If Ben needs cash flow in retirement, don't limit yourself to a bunch of companies paying dividends. Let him create a globally diversified portfolio of the best companies in the world, regardless of their dividend policy, and then sell small parts of the portfolio when money is needed. This will give Ben tax control. It will allow you to invest in fast-growing industries, and it will align his strategy with the mathematics of wealth creation, not the psychology of fear. It's time for Ben to stop letting the illusion of free money determine his future. Focus on growing total capital, not just eating crumbs. If this video made Ben reconsider his strategy, he will like it. Subscribe to learn more ways to hack the system. Ignore the noise and build a portfolio based on mathematics, not myths. See you in the next video. Ben went to review his briefcase.